Bank of America really cares about small businesses. That's why stablecoins shouldn't be able to issue yield. I'm like, okay.
They talk so much of quantity and they pretend as if they don't have a price lever themselves.
Well said. Big banks are using small banks as human shields, basically. And it's like they're trying to kill them anyway. To quote the former CEO of Goldman Sachs, they are doing the Lord's work. They take my money, they park it at the Fed, they make 3.6%. It's increasingly capitalism for me and socialism and cronyism for thee.
If, let's say, somebody at Treasury were watching this, or somebody in the White House, what would you advise them?
Tokenized bank deposits. Every time I'm here that I'm like, that's not a thing and might never be, and you don't know what you're talking about. This thing keeps happening in crypto where the industry just like violently swings from one extreme to the other. So we went from this original Bitcoin maxi, or even like what Terra Luna was trying to do, right? Like we all
the suits.
Fuck the suits and we will build a completely different financial system that has nothing to do with them.
Right.
That was dumb with tokens on chain, decentralized global settlement systems, and smart contracts. The whiteboard of how you design financial products becomes infinite.
I guess to start off, let's talk about what's happening with the banks lobbying against stablecoins paying interest. Omid, you've always had such an interesting and provocative take on this.
Yeah, so let's start with the headline, which is that after the passage of the Genius Act, there was a permissible method of stablecoin issuers indirectly sharing their yield with stablecoin holders through a third party. Seems perfectly legitimate by the language of the Genius Act, and Congress passed that law, and it wasn't that long ago. So many of us thought the issue was settled, but now with the market structure bill being hotly debated, the banking lobby and its supporters has demanded that additional language be added to the market structure bill that basically prevents holders of stablecoins from earning interest, any interest that originates from the issuer. I guess DeFi interest might be a separate issue. And I have been very animated and at points angered by the debate around this issue because I think it's based on a lot of fundamentally false premises, all of which happen to protect the profits of the largest banks in America.
Love to dig into that. I think there's so many arguments flying around, and I think many times perhaps intellectually dishonest arguments. Mm-hmm. I guess like to play the devil's advocate, so I'll be the big bank in the room, I guess. I'd say that as a big bank, I say that, look, if stablecoins start paying interest, then my deposit base will disappear. All these people will leave me. And I do a lot of the lending in this country. And so if you don't want lending to happen, if you want lending to die, support stablecoins. What do you say to that?
So the first problem I have with that assertion is that banks do not do a lot of the lending in America. They account for approximately 1/5 or just 20% of credit creation. And a lot of people are surprised by that statistic. It's higher in other countries, but it so happens that here we have very robust capital markets for things like mortgage-backed securities, right? Like the average mortgage that an American takes out today ultimately does not sit on the balance sheet of a bank. It's just part of a portfolio that somebody invests in. And that somebody could be an ETF, or it could be a pension fund, a sovereign fund, wealth fund, whatever. So our capital markets are very robust as a means of credit creation. We also have very large non-bank lenders like private credit funds, insurance companies, so forth and so on. And so anybody that argues we need to protect banks from competition because without banks there'd be no credit is already misrepresenting the information. So that's problem number one. Problem number two is that people are not going to willy-nilly pull their deposits from a bank account just because. They need to have a reason to. And that reason is either, if they're going to a stablecoin, because they're able to do something with a stablecoin that they can't do with a bank account, like, for example, make instant payments around the clock, or because they're earning a higher interest. The banking industry is very well positioned to compete on both fronts. They can build better payment infrastructure. In fact, every single major bank claims that they are. Now, I am often suspicious of those claims because if you spend years studying the profits of how money moves through the banking system, one of the things that becomes remarkably clear is that many of the things that are annoying to me and you, like the fact that a wire sometimes takes a couple of days to arrive, makes money for them. So when they say we're doing everything we can to speed up wires, color me unconvinced, because that's like them saying we're doing everything we can so we make less money in the future.
Right.
And so banks could compete on the infrastructure side if they want to. And if that costs them money, by the way, welcome to America in the year 2026, right? Who isn't facing some kind of a major competition from better technology and having to evolve?
Right.
The second thing that the banks could do is they could just pay more interest. And I say this because right now the national average of what American banks pay to depositors for what we call demand deposits, which are things like checking and savings accounts, is around 1%. The prevailing interest rate is around 3.6%. And the difference is one of the key ways that banks make money. This isn't just a speculation or an accusation. All anybody has to do is to look up the earnings reports of all the biggest banks, scroll down to the point where you see their net interest margin. That's the difference between what they pay depositors and what they charge borrowers. And it's a quite robust number that cumulatively adds up to something like $250 billion a year in profits. So if stablecoins do pay interest, maybe, and this is still speculative because there are many moving parts, but maybe some people say, well, I'm going to move my money to a stablecoin unless the bank pays me more interest. The banks are more than capable of doing that. It would mean that they make less money. But I am not aware of any other situation in America that lobbies for making consumers and ordinary citizens worse off just so the industry could make more money.
That makes sense. I mean, if you think about it simplistically, they are borrowing at near zero, and then they are making 3.5%. It's a good business if you can get it, and it's a lot of money to hire lobbyists and to sort of marshal the forces of darkness to kind of keep things the way they are.
Yeah, look, one of the simplest things a bank could do when you deposit money with them is to take that money and park it at the Fed. Reserve requirements are currently actually zero. They're just capital requirements, but all banks keep some billions of dollars with the Fed, either to meet their capital requirements, they have all sorts of other liquidity requirements, or to make payments. But the Fed also pays them interest on their reserves, and it pays them 3.6%. So if I go open an account at Bank of America, they pay me nothing for a checking account. They take my money, they park it at the Fed, they make 3.6%. There's no risk to that, by the way. The Fed is the safest bank on planet Earth. There's no operational cost. It's not like they're underwriting mortgages or giving small business loans.
Right.
And to add insult to injury, the Fed's revenues or costs ultimately filter through the Treasury Department. The Treasury Department are financed by our tax dollars. So if I deposit my money at the bank could deposit it back with the government, earn interest that comes from all of our taxes, then have the audacity to say that me wanting to earn 1% or 2% interest on a checking account somehow leads to people not being able to take out loans anymore.
It's insanity. I guess, like, what is the steelman, if there is any, of their position, right? Like, what it sounds like daylight robbery, what you're describing, right? You borrow from a captive pool of people who must lend you money at virtually zero. You have these tiers of access. You know, if you're gold, you might get 10x the usual interest, which is, 0.001%. If you're platinum tier, you might get 50x, which is still basically de minimis, zero interest. And not only that, but it seems that you benefit from a regime where structurally the government will pay you to do this. So I'm curious, kind of like, what is the steelman, if there is any, of the banking lobby's position?
So the steelman is that it is possible that certain kinds of lending ultimately do become somewhat more expensive to the borrower.
Yeah.
If there's enough competition from stablecoins or even fintechs or money market funds.
Right.
As you know, the banks tried to kill money market funds 30 years ago, made the same arguments, failed. Now there's $5 trillion in money market funds, and guess what? There's more deposits in the banking system than ever, too.
Right.
But the steel man is, no major disruption is ever 100% a benefit. Right? So it's possible that there are certain kinds of borrowers that do end up having to pay more. The thing that's fascinating to me, though, is that underlying all of this debate is this general assumption that borrowers matter and savers don't, which I think is fascinating. And this isn't just like a hypothetical. The CEO of Bank of America, Brian Moynihan, was recently asked, I believe on their Q4 earnings call about stablecoins and yield in this debate. And he said something like, oh, well, we're concerned about small business lending.
Right.
So I went and looked up the numbers, and it's true that about, I think, 50% of small business lending in America does originate from banks.
Right.
The rest of it, again, there's the government, there's securitization, but it's a significant number. I think something like $700 billion of credit outstanding, and I, like everybody else, want small businesses to succeed. But then I thought about it, I said, wait a minute. What percentage of small businesses go get a loan from a bank like Bank of America? I don't know what the answer to that is, but I imagine it's fairly small. Yeah. Right? If you think about like every startup, and when we say startup, we might mean like a crypto startup, an AI startup. Every new restaurant, every deli, every graphic designer who has an LLC is effectively a small business.
Yeah.
Right? I myself have probably had like 10 different small businesses throughout my life that I own something of, right? The vast majority of them will never take out a loan from a bank. Would you agree with that?
I think that's right. I even have trouble visualizing what these businesses actually are. Like who are these businesses who are borrowing from banks? It's kind of difficult for me to imagine. I can imagine the mortgages, right? But again, the banks seem to originate and pass on that exposure today. It doesn't seem that they really hold on to it. Again, I have trouble visualizing who this business is.
So they're out there. Let's assume like maybe somebody has a chain of restaurants and they want to open a new location and they have enough revenues that, I mean, the other thing is like banks don't just give credit to anybody, particularly if you're a small business and you probably don't have the kind of assets that you could do like secured lending or the kind of cash flows that a large corporation has.
Right.
But let's say there's $700-800 billion in loan outstanding to small businesses. Fine. What percentage of, so I think we agree, and I don't think anybody would disagree, that a small percentage of small businesses borrow from a bank.
Yeah.
What percentage of small businesses lend money to a bank?
All businesses with a bank account, I guess, is your point there.
That's right.
Yeah.
So I thought, wait, this is fascinating. Brian Moynihan says Bank of America really cares about small businesses. That's why stablecoins shouldn't be able to issue yield. I'm like, okay. So I went to their website and I looked up their small business checking account.
Yeah.
I believe if you meet a small minimum of deposits, right now they pay 1 basis point in interest. And to the point you said earlier, they do have like the platinum tier. If you keep X thousands of dollars with them, that pays 5X, and it's 5 basis points. So putting all this together, I was like, wow, how disingenuous is the CEO of Bank of America? Because he says, well, we care about small businesses. But the activity that every small business does, you pay them nothing. And the small minority of them that you argue might get a loan maybe somehow someday, oh, well, if stablecoins issue yield, maybe that loan is 50 basis points or 100 basis points higher.
Right.
So one of the cool things about this debate is if you take a step back and if you don't have any particular bias, right? Like I'm not a bank executive or shareholder. I'm also not.
Or a stablecoin company.
But I'm also exactly. I was just going to say, I literally have no financial interest in any kind of stablecoin business right now. Yeah. But I do believe in better, newer technologies. I believe in efficiency. I also believe in like ordinary people benefiting from the financial system because we do have a very top-down financial system where somehow when times are good like now, bank shareholders and executives make a lot of money, but then when times are bad, they get a lot of bailouts. That's always bothered me. And I think blockchain, public decentralized infrastructure, stablecoins could disrupt this model for the better. So I'm advocating for that. But since I don't have the typical biases, when I zoom out for a second, I said, wait, there's some really interesting assumptions in this debate. The first assumption is that borrowers matter more than savers, even though there are far more savers than there are borrowers. So that's interesting. And then the second assumption is that the optimum amount of credit in the economy is more. Because everybody always says, well, credit creation. Well, there's plenty of debt in the world today. And it's various kinds of it are fairly affordable. But who decided that we need to design a financial system that always nets out more debt? Especially when that debt, one, comes at the expense of saving money and the interest that like a retiree like my mother, who primarily lives off of fixed income, like she's not going to be out in the market for a small business loan anytime soon or a mortgage or anything like that. She happens to keep a lot of cash in very safe things like bank accounts and money market funds. So who decided that like she needs to be the one who loses out here? And if somebody did, we should explicitly state that. So that's an interesting assumption. Then there's also the assumption that whoever is in the business of lending and creating debt should be able to make as much money as they can by doing it. And there's an incongruence here, because when the banks talk about the risks of things like stablecoins and yield-bearing stablecoins, they often present themselves like they are a utility or almost a nonprofit, right? They say, we're providing they don't say, we're here to make money, and if stablecoins pay interest and we have to pay our deposit more interest, we'll make less money, right? Nobody ever says that.
They say that in the 10K,
but not
Good
point.
Not for congressional testimony.
Yes. I mean, and in their defense, when crypto industry players go up and argue for the yield-bearing stablecoins, they don't say this is going to allow me to take market share and grow. They say this is good for the economy, good for customers. But again, like I'm not any one of those things. But the banks, interestingly enough, present themselves as like they're a utility, right? To quote the former CEO of Goldman Sachs, Lloyd Blankfein, they are doing the Lord's work, which is one of the assumptions in the debates, right? And you see this with members of people in the executive branch, members of Congress on both sides of the aisle say, well, we got to make sure that the bank-enabled lending continues. That's almost like saying, well, we got to make sure people can get electricity and running water.
That's right.
But then utilities are highly regulated. And one of the things that they're regulated for is what they get to charge, right? Because this trade-off that utilities are something of a protected class when it comes to the private sector.
Right.
It's heavy regulations to the point that in many places, utilities can't just raise their prices. So the regulator will literally look at their margin and say, whoa, you're already making enough money to justify compensation for employees and the additional capex for infrastructure build-outs. If you're going to raise prices, this is like monopolistic behavior, and we're not going to allow it, right? We're going to cap how much you can. But the banking industry wants to have it both ways. Because anytime there is the possibility of competition, whether it was money market funds in the 90s or stablecoins today, they say, well, we're a utility. But then when it comes to like, okay, should we cap credit card swipe fees? Oh, no, we believe in free markets, right? Should we have maybe a windfall tax on the net interest margin that banks made from, capitalism. In America, we believe in free markets. This is socialist European style. That particular one I think is ironic, because if we take them for their word that their real concern here is credit creation as opposed to profits, then surely they would have no problem if a bill is passed that say banks can no longer make more than 1.5% in net interest margin. Right? Any savings they get from not paying interest on deposits must flow to borrowers.
That's right.
It cannot flow to shareholders.
They talk so much of quantity, and they pretend as if they don't have a price lever themselves.
Well said.
Yeah. Why can't they just lower the price, right? and create more quantity. That makes a lot of sense. I'm curious, like, are you a buyer of bank stocks at these levels?
No, I'm not an investment advisor of any kind, and
This is not investment advice.
yeah, I mean, I do know that the particularly big bank stocks have done very well because of the general perception of deregulation of banking under the Trump administration. Some of which might actually be sensible, by the way. Like, it's quite possible that after the 2008 crisis, there were way too many shackles produced on banks. My problem is always like, they should have more freedom to do what they do, and then we should just not bail them out, and then they'll figure out how to do it responsibly. But no, I do think, regardless actually of where the stablecoin debate falls and what ends up in the market structure bill, they are on the losing end of a massive transformation of the financial system, that the availability of these public blockchain networks is going to enable one way or another. Because at the end of the day, the main thing, particularly the largest banks have going for them, is access to the infrastructure, right? A lot of our most important payments or capital market infrastructure, whether we're talking about sending money around the world or trading securities, it is either directly owned by the largest financial institutions, right? Like, they own the clearinghouse, the confusingly named the clearinghouse, which is a clearinghouse that competes with clearinghouses run by the Fed. So the banks own Early Warning Systems, which was a company that created Zelle. Or if they don't own it, they have privileged access. Right? So you and I can't show up to the Fed and say we want access to the Fed's clearinghouse. You have to be a highly licensed, regulated financial institution, blah, blah, blah. So there is and I don't use this term lightly, there is a privilege that the largest banks enjoy today, which, by the way, again, go read their 10Ks and see where they're talking about where growth will come in the future. A lot of it is about like transaction backing and payments and cross-border, because they control the pipes. We now have new pipes that nobody controls. So one way or the other, I think that's going to disrupt their business model.
That makes a lot of sense. I'm curious what you think of, are there strong arguments? Like, what if you were to steelman the stablecoin case, right? Like, stablecoins are clearly a structural buyer of treasuries. You know, the more there is a structural buyer of treasuries, the lower the yields should be, right? Is there some stronger argument there that, in fact, actually that's even better for society?
Yeah, that's a great point, actually, because let's go back to this availability of credit argument that the banks make so vociferously. First of all, you would know better than me. Right now, 99% of dollar stablecoin demand is from offshore. Is that a fair saying?
Most of it's offshore.
Most of it, like the vast majority of it, is offshore.
Yeah.
And the offshore stablecoin demand, probably most of it is net new dollar adoption. Right? Yeah. It's not people like substituting a dollar bank account for a dollar stablecoin. It's right. People using a dollar where otherwise they would not use a dollar. And that just ultimately means more capital that flows into the bond market and more deposits that flow into the banking system. Right? People also forget this, that it's very hard to have any money come into an economy and not have some of it end up in the banking system, even with stablecoins. Right? Stablecoin issuers need to keep a bunch of money at banks because they need to make payments and do other things. So there is a world in which, even if stablecoin issuers are allowed to pay interest, the bank deposits in the US go up as a direct result, because there's just more people holding more dollars in more places that they don't today. So right. That's the international adoption argument. That's literally the claim that stablecoins paying interest reduces bank deposits is a lie argument.
Because the money is coming from overseas in the first place, right?
Yes.
So it's not a substitution effect, it's an addition effect.
It's literally like, think it through, right? Somebody overseas buys Tether, whereas otherwise they would hold a offshore bank account or a foreign non-dollar denominated asset like real estate.
Right.
So they buy Tether, there's more USDT. Tether, the company, has to buy more treasuries.
Right.
That's just money coming into the dollar system. And ultimately, that flow, I am confident, will increase net deposits for U.S. banks and reduce their cost of capital.
Does it also reduce the risk-free rate across the economy? Is that the way to think about it? Or?
Yeah, very good. I was actually going to say the next thing is whether it's offshore or domestic. Let's say that your typical stablecoin issuer puts 85% of their reserves in T-bills.
Yeah.
That is literally the risk-free rate. And that's like everybody takes high school economics. There's this risk-free interest rate. The closest thing we have to it is T-bills.
Right.
So now what we're saying is that the risk-free rate that every other kind of credit, even bank credit, is benchmarked to is going to be effectively lower. Now, the T-bill rate is tied to Fed funds and other levels controlled by the Federal Reserve. So it's not necessarily that like whatever T-bills are paying today would go down. But if nothing else, more demand for T-bills means that the Treasury has a lot more flexibility on how it manages the yield curve. It can issue more T-bills, for example. It means one way or another that the net cost of overnight borrowing in the U.S. goes down for everybody. So now go back to where we started this conversation. Right? If 80% of the credit is created by capital markets and non-bank entities, all of that, or almost all of that, most of it is benchmarked to the Treasury market. So then more demand for stable coins means lower Treasury rates, means the 80% of credit that's benchmarked to Treasury rates is also going to be lower. It means cheaper borrowing for almost everybody throughout the economy.
Right. There'll be some credit fund analyst sitting in Midtown here, and his spreadsheet has SOFR plus whatever, risk-free rate plus some spread, and that number will go down programmatically if there's more purchasing of short-term treasuries.
Yeah, I mean, there's a reason why Treasury Secretary Bessent has been such a huge fan of stablecoins. And by the way, the same reason is why many Democrats are fans of stablecoins. Why even during the Biden administration, where they were generally hostile to crypto, they were much more open to the stablecoin idea. Because there's no such thing as a politician who says no to cheaper borrowing for whatever the programs that they believe in, right? You could argue it's their patriotic duty to advocate for cheaper borrowing that lets them either provide more services or cut taxes or whatever they want to do. So in that sense, it is possible that the net effect of widespread dollar stablecoin adoption is cheaper borrowing for the average borrower. And now, to be clear, no one knows for sure. And I am not a hardcore research academic, but I do talk to them. I have colleagues who've looked into this. I've tried to read every single paper that might be remotely relevant to this topic. I have spent an unhealthy number of hours with ChatGPT and Claude trying to steelman these arguments. No one can say for sure. What I can say confidently is that the oversimplified argument that if the mix of liabilities, of dollar liabilities that people and businesses hold shifts away from commercial banking to other things like stablecoins, it is far from given that this would result in there being any significantly higher borrowing costs.
Could you dig into some of that academic work that you're absorbing? I wonder, like, who are the best thinkers here? Who's doing the best work? Like, what are the sort of main arguments they're advancing? Like, where is it that we're unclear what's actually going to happen? Where are we very sure we're right?
The unfortunate thing is that there's two things. One, this is all so new that like real rigorous academic research often takes a couple of years.
Yeah.
Particularly if you're talking about collecting data, building a model off of it, projecting forward. There's a lot in the works that is not out yet. So that's challenge number one. The stablecoin debate is so new. Almost nobody was really taking it all that seriously. There are some interesting academic papers on stablecoins in general, but this very question of like, okay, if they pay yield in this way, then how might deposits in the banking system be impacted, right? That's challenge number one. challenge number 2 is, even aside from stablecoins, we're going through a period in academia where a lot of the fundamental assumptions about how banking and deposits work are being questioned. Like a very simple one historically has always been that deposits are sticky. That for whatever reason, people leave their deposits at a bank, even when there are better options. Like you could go to the bank across the street that pays more interest, or you could just sweep your money to a money market fund that pays a lot more interest. And this assumption impacted not just people looking at the economics and borrowing and lending, but questions of like, well, how do bank runs unfold? And what happened with the regional banking crisis and SVP blew up a lot of these assumptions because there were new variables that understandably nobody had accounted for, right? Like nobody had accounted for bank runs in the age of social media. Nobody had accounted for a bunch of depositors at a bank having a WhatsApp group or the same VC that says, hey, you know what, something's not right here, pull your money out.
Right.
And then the other thing is no one accounted for the fact that it used to be to pull your money out of a bank, even if you're kind of worried about its safety incentives. Like you would literally have to either call someone on the phone and spell out the instructions on how to get the money out. Maybe got to wait on hold for a while. It's got to be during banking hour. Or we have to walk down to the branch. I actually remember in 2008, when the financial crisis unfolded, going to a troubled bank, Washington Mutual, that did end up failing, and literally being like, I want to send my money out right now. And they're like, rah, rah, rah. And I'm like, listen, I want to send the wire. And it was annoying and it took time, right? But we now live in a world where increasingly you could just use an app, or you could use the bank's mobile, just use their website. So all of which is to say, the academic modeling of how deposits work is undergoing its own kind of disruption right now. And then finally, I think something else to be accounted for of this generational shift. Younger people don't use cash anymore. Younger people are actually much more comfortable with mobile first solutions, which tend to be fintechs. A lot of younger people, like, unless they live in New York City and you need to pay rent, which still is heavily dependent on bank checks, they're like, I just need a card. I got credit cards or ATM card, whatever. So I'm sure people smarter than me in the next couple of years are going to do very interesting modeling of how deposits might work in a future where information moves seamlessly 24/7, including, by the way, like false rumors of a bank run, which is unfortunate, but that's something that if you're designing a banking system, you need to account for.
Yeah.
And then the infrastructure is increasingly becoming faster and more digital. So it's going to be a lot of questioning of assumptions. But I will say, where there has been academic research, including by some of my colleagues at Columbia Business School, into this question of if something like a stablecoin or even a CBDC does suck some number of deposits out of the banking system, how does that ultimately translate to the availability and cost of credit? The numbers are always underwhelming. There's no such thing as an academic report that says it's going to be a huge problem and people will no longer be able to own a house, right? Usually it's like, well, some percentage of this and some percentage of that and and ultimately, okay, yeah, maybe some kind of loans are 30 basis points more expensive, right? But then the banks could just make less money and just eat that.
Right. If let's say somebody at Treasury were watching this, or somebody in the White House were watching this, like, what would you advise them based on what you know and based on all of your intuitions?
So one is that I think the position argued by the bank lobby, all of their assumptions should be questioned. There's one we didn't even talk about, which is, I think, an important one, which is the more recent thing is that the big banks or the trade groups that represent the big banks are weaponizing the risk to community banks. They say something, well, we'll probably be fine, but these community banks, they stable coins. That, I think, is the most disingenuous argument. it's almost shameful that they would even say such a thing.
Yeah.
Because first of all, most of the biggest banks in America, JP Morgan, Bank of America, Citibank, if you look up again their public pronunciations, they're currently implementing some kind of a plan to increase deposits. Right? Like Jamie Dimon, CEO of JP Morgan, I forget what the number is, has a target of the total percentage of US deposits that it wants to have. Wells Fargo is recently just coming out of consent order and regulatory restrictions on the size of the balance sheet. So now it's going to try to grow its deposits. PNC Bank, which is like one tier below the largest banks, CEO talks publicly about how they plan to open more branches in new cities where they don't operate. He was on a podcast recently where he recently said there's some number in banking where it's generally believed that if you have that percentage of the branches, then you get some weird network effect where you can attract more and more deposits. So the question I have is, if all the biggest banks in America are simultaneously trying to grow their deposits, where do we think those deposits are coming from? And before you answer that question, let's go back to the post-SVB collapse regional banking crisis. A lot of money left other smaller regional banks. Where did it go? It went to the too big to fail banks. Why? Because they're too big to fail.
Right.
So at a time, and then also for people who don't know, America has thousands and thousands of small banks. It is very unusual in that way. And it's always been very controversial that it works that way. There are benefits to having a lot of small banks, like a small bank is more likely to take a risk on a small business. A small bank is more likely to have relationships with like ordinary people in a rural part of the country.
Right.
A small bank, frankly, a lot of the rural parts of the country might not be banked at all if they didn't have a small bank. The downside, though, is that small banks are more vulnerable to whatever happens in their local community, right? Like if you're a ag bank that primarily lends to farmers in one or two states, you're going to be more vulnerable to a bad crop.
Right.
Concentration of deposits, it's generally riskier. Small banks also understandably have a harder time spending money and keeping up with the latest technology upgrades, or like even having a mobile app and IT systems and stuff like that. So that's the state. The number of small banks has actually, I think, fallen by half since the 2008 financial crisis, partly because they or their deposits keep getting swallowed by the big banks. So for the big banks to not come out and say that, oh, stable coins are going to hurt these guys, right? I mean, the other things people should know is that community banks already pay more interest than the too big to fail banks. Why? Because they're not too big to fail. So they have to compensate their depositors.
Right.
And two, demographically, their deposit base skews older and more rural. So now let's put all of this together. Let's say that Genius is left as is. There's no ban on interest payments for stablecoins. And you can get 3% at Coinbase by holding USDC. Do we really think that a 65-year-old farmer in Nebraska that banks at the local community bank that has like 100 million in assets and is run by his cousin or friend, that person is now going to be like, what I really want is a digital wallet where I need to like back up my private key so I have something called a stablecoin just so I can make 1% more interest? I don't think so. I think actually the bigger threat is going to come from the younger, savvier people for whom they're screwed economically anyway because of their student loan debt and incomes haven't been going up. And they're like, wait, I can make like a 4 times, 5 times interest by clicking 3 buttons. And maybe they like the idea of a digital wallet. And then businesses for whom stablecoins are very appealing, not because of the yield that they pay, but because of the payment efficiencies that you can explain to them better than I could, especially if they're doing cross-border, weekends, all sorts of things. So all of which is to say, I do not think that in the foreseeable future, even if stablecoins pay a lot of interest, or any threat to community banks. For the big banks, though, to argue that, one of my smart friends had a line which I love. He said, the big banks are using small banks as human shields, basically. And it's like they're trying to kill them anyway, but now they're trying to use them in the stablecoin debate. And as a last point on this, just to show again how disingenuous the bank lobby is, there is currently a proposal to increase the FDIC insurance limit on smaller banks. I think up to something like $10 million from the current $250,000. And to fund it by having the GSIBs, the too big to fail banks, pay for it. What I consider a very reasonable argument for this proposal being that if the too big to fail status of banks like Bank of America, Wells, JP, Citi is going to enable them to continuously suck deposits out of smaller banks every time there's any kind of a recession or economic risk, then they should be the ones forced to pay for the increased deposit insurance that'll keep those deposits in the community banks. Right? I think that's a very reasonable argument. Ultimately, the too big to fail banks have infinite deposit insurance paid for by me and you.
That's
because
right.
It's our tax dollars that will bail them out no matter what. So then say, okay, guys, pay some of that, a fraction of that forward. But of course, the big banks are trying to kill that.
The big banks want free market rules to apply with respect to big bank and small bank.
Yes.
But with respect to big bank and stablecoin, they don't want free market rules to apply.
I like that. I hadn't thought of it like that. Very good framing. And the final point, in America, we also have these very interesting nonprofit financial intermediaries called credit unions. And because of their nonprofit status, credit unions do what the big banks pretend to do, which is they pay more on average to depositors and they charge less on average to borrowers. They're also safer because they have more stringent capital requirements. So whatever the big banks say they worry about for the small banks, it's also true for credit unions. So, of course, the big banks are lobbying to have the tax-exempt status of credit unions thrown out because they say, well, they have an unfair advantage, which I really don't understand because they're nonprofits. They don't have equity. Like the executives who work at these places, some of them are very large. They have a lot of responsibility and they work hard, but they don't get shares. They don't get like 30 million or 3 million or whatever payouts in equity for doing a good job. Then the bank lobby shows up and says, oh, but their institution should be able to pay income taxes, even though it has no income. The income is literally passed through the institution. Depositors get more interest. Borrowers pay less. And by the way, if you ever meet the leadership of a credit union, you should ask them about. There's a fascinating thing where a lot of their borrowers are the executives of the for-profit banks.
Oh, interesting.
Because they know they can get a cheaper mortgage from a credit union.
Where does the chef eat?
Yeah, exactly. But at the same time, this behind-the-scenes lobbying. So to your point, I'm a capitalist, and what actually bothers me about Wall Street is that it's not. It's increasingly capitalism for me and then socialism and cronyism for thee. And I think they should just have to compete. And look, I worked on Wall Street. We know a lot of people who work on, I'm sure you do too. They're really smart. They're really capable. Let them fight on the merits. And if it ends up being that they make a little bit less money at the end of the year, who cares?
It's interesting to think about what really is the core of the business. You think about a Coca-Cola, and naively you might say, well, the business is a beverage business, but really the core of it might be that it's really a marketing business, right?
Interesting.
And with banks, it's interesting. Obviously, I went to Wharton, so I know a lot of these people who end up at JPM or whatnot. And I think a thing they say at JPM or 200 West or whatever top firm it is that our people are our assets. And all of our assets leave the building at the end of the night at 2 a.m. And I guess perhaps there's something disingenuous about that. Perhaps the core of the business is this kind of regulatory capture that you're talking about.
Yeah, I think And I actually think if you get your typical senior bank executive off the record over drinks, they will agree with all of this, that their regulatory possession and their perception of being too big to fail is just great for business. That's not great for the rest of the economy, though. And then the other, we haven't even talked about this, but the other debate between stablecoins and levered banks. People use these terms like full reserve, fractional reserve, et cetera. They're very archaic. I like a stablecoin. A genius regulated payment stablecoin is a non-levered financial institution or a narrow bank. JP Morgan is a highly levered bank. And there's been this other debate going on that actually predates stablecoins, which is, should we allow narrow banking?
Right.
Like famously, people have tried. Famously, the Fed and the regulators have said, no, we shouldn't have banks that are too safe because then they're not creating credit. Again, we now know that that's also disingenuous because banks don't create most of the credit. But what about the cost of having a highly levered banking system that blows itself up every 5-10 years? Right? No one talks about that. It is a massive cost. And the headline of it is just go add up all the bailout money that all of these institutions have gone, which actually is hard to calculate because during COVID, the US government and every other government basically said infinite bailout money. We will underwrite this system no matter how much money we need to borrow and print to do it. Shockingly, a couple of years later, we had record high inflation. I wonder how that happened. But that's one cost, right? And it's a cost to me, you, and everybody else. Then there's the cost of just instability from periodic banking crisis, because that instability leads to people reining in investment and consumption and being more risk averse and companies hiring less because maybe the bank is going to blow up. And then the third cost is a cost in terms of this enshrined position that many institutions have now, because everybody knows if they blow up again, they'll just get bailed out again, which then means that we need to have like massive regulations like Dodd-Frank, which impose onerous costs on everybody.
Right.
But we still get banking crisis. So going back to this debate leading to a lot of false original assumptions, I think one that it's time to revisit is maybe we should just have a less levered banking system.
What would that world look like? So I guess one argument would be that it doesn't look very different because the premise is most of lending doesn't actually happen through the banks anymore. I guess another argument would be to say it's a better world. It's less cyclical or something like that, less pro-cyclical. I wonder which one you think is the more realistic one and why?
I think it's definitely less pro-cyclical. I don't think financial crises are a solvable problem per se. But I do think you can have some just basic design primitives that make them a bit less frequent and a bit less violent. And just having an overall less levered system is one. I think other benefits of something like stablecoins is we would actually have a much better idea of how levered the system is. I think with stablecoins, it's much easier to prevent fraud. Back before the debate about stablecoins was around yield, if you remember, the debate around was whether they could work. This is like circa Tether rumors, some of which turned out to be true, by the way, but also, like the ones that they didn't always have the reserve, but also nonsensical conspiracy theories as to Tether has no reserves and it's all just a Ponzi scheme, which I never understood. But I would get into these debates with regulators, people who worked in banks, and academics all the time because they would say, oh, the stable coins are dangerous. And I would say, okay, let's battle test that idea. And one of the most important things you can do or you need to do for any financial intermediary, whether it's like a highly levered bank or a fintech or a narrow bank, is make sure that assets and liabilities match, right? Because many times the biggest frauds that happen, the kind of things that lead to banking crisis, is because we find out later that someone's assets didn't match their liabilities.
Right.
And I would play this game with whoever was arguing this. I would say, watch this. I am going to tell you all of Tether's liabilities down to the fraction of a penny in a 100% verifiable way in 30 seconds. And I would pull out my phone and I would go to Etherscan and other blockchain explorers and pull up the token supply and say, look, these are their liabilities. It's not coming from them. They can't lie to me. Tether cannot lie to me about how many ERC20 tokens there are on Ethereum that are theirs. Now they can lie about the assets, and they have historically. Right? They could misrepresent whether they hold treasuries or whatever. But if you have half the information, it makes it a lot easier to verify the other half. Now take your typical levered, complex, opaque bank. I promise you, you and I right now have more information about Tether's liabilities than Jamie Dimon could ever have about JP Morgan's liabilities.
Well, what creates that complexity that makes it so hard to understand? Like, let's say Jamie calls together whatever VP of, I don't know what the title is, VP of Ops or something, and says, hey, look, I want to understand my position. Like, why is that so difficult for him to get that output?
It's a giant, complex global institution that holds assets that live inside of many different archaic payment and settlement systems that run on COBOL and do not update 24/7 and have a massive error rate, right? Like if you just look up the news of occasionally a big bank will get fined for some operational issue. And he's like, oh, and if you ever worked inside these things, like, wow, it's really hard to have a real-time understanding of what's going on. So that's one problem. And I'm sympathetic to that because it's not an easily solvable problem. It's not their fault.
Right.
Right? I wouldn't like expect a multi-trillion-dollar balance sheet organization to rip open all of its IT infrastructure tomorrow and replace it with the most cutting-edge database tech or whatever. Also, a lot of this is not up to them. It's like, well, we use this payment system in Southeast Asia, and this is just how it works.
Right.
The other issue is that opacity is just part of the core design of TradFi, right? And the fundamental challenge is that you have regulations and you have auditors, but what they all do is they show up to an institution and say, give me the data I need to make sure that you're not lying to me about your data. Because I need to know what your assets are, what your liabilities, your leverage, whatever, right? Where do they get that data? From the very institution that they need to use the data to hold accountable. In a world that more things move on chain, we have more trustless sources of information. Now, there are serious privacy questions that arise, right, which are also important. But ultimately, I think if payments move on chain with stablecoins, we can achieve a new equilibrium where there is a lot more transparency that can be used to make sure that stablecoin issuers do the right thing, to make sure that that banks don't lie. And when we get to DeFi, it's like, well, if you believe there's an optimum leverage ratio that's the ceiling for this protocol, it should be hard-coded in the smart contracts. It shouldn't be like, let's hope the executives do the right thing, which is how it works today. So I think that's an equilibrium where there is a lot more transparency and stability, but there's definitely not less privacy. Because the thing to remember about privacy is like, yes, there's no equivalent of Etherscan in the banking system.
Right.
But my bank knows everything about me, which I don't like.
Privacy with respect to who?
Right. I mean, if you just think, people always worry about like what the social media algorithm knows about you. Well, what about what your credit card company knows about you? That's the more I think about it, the more disturbing it is. Because like, well, they know what time I took this when I took the subway today, right? And they know what subscriptions I subscribe to. They know when I travel and where. So anyway, I think just focusing on things like, well, do stablecoins pay yield or not? Yeah, you pay yield. Undersells the benefits of moving payments and capital market activity onto these decentralized, global, transparent settlement systems, which is how I understand the public blockchain to be.
Totally. You've also been skeptical. I think there's been a vibe shift in crypto, right? And the vibe shift has sort of made a lot of the natives maybe reflexively kind of just like anything that sounds traditional is good, right? Like think like Citadel, good, right? Like JP Morgan, good. It's basically a 180-degree vibe shift from, let's say, 3 years ago. You've been a noted critic of some of this thinking. I wonder if you might express some of your thinking there and the source of your criticism.
So my operating assumption since I got into crypto has always been that there will be some convergence between DeFi and TradFi.
Yeah.
Particularly when it comes to the assets. Because like I love pure native digital assets like Bitcoin and ETH. I think they are these unbelievable new financial primitives that give you property rights and assurances as to things like their inflation rate that have never been possible before, which is super cool and very, very useful for a lot of economic activity. But there's still equities and debt and fiat currency and real estate and all those other things. My operating assumption has always been that eventually all assets will be tokenized assets because it's better infrastructure, and then we'll just call them assets. Like ultimately the infrastructure becomes less important. So I love this current moment. I think as like an early hardcore believer in Bitcoin's decentralization and value, I also love stablecoins. It's like, why not have both? What I really don't like is when the crypto natives say that they're now going to integrate some aspect of TradFi without really thinking through how going on chain properly will disrupt that aspect of TradFi. And just to give you like specifics, right? If you take the current capital markets stack, let's just look at stock trading in the US. We have clearing houses and what we call CSDs or centralized security depositories, many of which live inside one company, the DTCC, right? And then on top of that, we have exchanges like the NYSE, the NASDAQ, some smaller players. We have custodian banks, we have broker dealers, retail brokers, and ultimately there's me and you. It is a very vertical and hierarchical system that has very clear winners. That structure, when you move on chain, doesn't make sense anymore. Right? Today, many of those firms, the clearinghouse, the CSD, the exchange, the custodian, the broker, they exist for a very good reason. We would not have our successful, robust capital markets without them. But they also exist because we don't have something that looks like Ethereum. Because if a company can issue a token on a blockchain and say, that is my equity, well, now you no longer need a centralized securities depository. The blockchain is that. You no longer need a transfer agent whose job it is. You might no longer need exchanges, or at least these exchanges, because we have DeFi. We have automated market makers, right? Like I'm a big nerd of if you create these different financial primitives, what cool new activities could people far smarter than me come up with, right? And we've already seen this with perps. We've seen this with AMM, the constant product function AMM. It might not be, the Uniswap model might not be the most efficient way to trade every single asset on earth, but it's cool and different and clearly successful. So my issue is often like if someone comes to me and says, the DTC is going on chain. And I'm like, okay, how is the DTC being radically transformed in a way that eliminates power and profit for some people while allowing it for other people? If you don't have an answer to that question, the DTC is not going on chain. They're pretending. They're doing innovation theater. They're doing pilots. They're doing completely nonsensical things like permission blockchains, which they're not even blockchains. To me, if it's permission, it's a bad database. It's the worst of both worlds. And some version of this is true for a lot of TradFi firms, right? Like Visa is doing some very interesting stuff with stablecoins. But if all payments move on to stablecoins, there is a really open question as to the utility of Visa's primary way of making money today. Now, can they reinvent themselves? Yes. Is it easy to do? No. And having worked with or in these institutions, you do have the classic innovator's dilemma that they're often very smart people who see the potential for stablecoins, for disruption, for blockchain, and say, let's do this, this, and this, because there are valuable things. If the world moves on to decentralized network, there are valuable things that Visa could do, and the DTCC could do, and the New York Stock Exchange could do, right? These are very, very professional organizations. They frankly do many things better than anybody in crypto does, right? They do risk management better. They're just more buttoned up in a lot of ways. They have a lot of talent. But the problem is those things that they could do are very different from what they do today. And just classic problem, which is like, are you willing to actually cannibalize your existing profits? And power. It's not just about profits, right? Like
who has power inside the company? Who has power?
Yeah, like the DTCC actually does not make a lot of money, but that's because it is consortium owned by the largest banks and brokers. And they create a nice moat for themselves where new competition is very rare. Because basically to tap into that infrastructure, you have to get permission from your competitors. So good luck with that. This thing keeps happening in crypto where the industry just like violently swings from one extreme to the other. So we went from this original Bitcoin maxi, or even like what Terra Luna was trying to do, right? Like
fuck the suits, yeah.
And we will build a completely different financial system that has nothing to do with them.
Right.
That was dumb. But now when I see the pendulum swinging the other way, it's like, well, we need them. So whatever they need to come on chain, we'll just give them more suits.
More suits. The company gets a press release, right? The crypto startup gets a press release. The traditional institution gets to have a PowerPoint slide, perhaps, at the next board of directors meeting.
Oh, yeah.
How innovative they are.
On the next earnings call. Right?
And the next earnings call.
We didn't even talk about tokenized bank deposits. Right? The number of times that banks say, we don't need stable coins. We're going to do tokenized bank deposits. And every time I'm here that I'm like, that's not a thing and might never be. And you don't know what you're talking about.
I feel like that's been like a favorite position of like kind of the Bank of International Settlement people as well, right? Kind of all the traditional banking folks love this idea of tokenized deposits.
Yes, well, it's not the narrow Bank of International Settlement.
That's right. I suppose it's like kind of the easiest thing to reach for, to say like, we will continue to be, the primary players in this new world as well, right?
Yes.
Yeah.
Yes, but I don't think any of them have actually
thought it through.
Like, how do you do deposit insurance on a tokenized deposit? We literally, with the recent crypto crash in early February, Tether started trading at a slight discount on exchanges in the secondary market, which is not unusual for stablecoins.
Yep.
Doesn't mean they've depegged.
Totally.
Right? It just means that right now there's a bunch of people who want out, and they're okay, taking some BIP loss on it. And like no one cares because we generally assume that Tether is fully reserved.
You see the opposite in bull markets, right? Tether tends to trade above par.
There you go. Yeah. Now, imagine you have a tokenized bank deposit and you see on crypto Twitter that someone's like, tokenized Bank of America deposits are trading at 0.998.
And they're 20 times levered.
Might that cause a run? Right? Because the money isn't there. Unlike with a stable coin.
That's right.
I have, to put it in academic terms, I have raised the issue of secondary market price discovery on the liability of a highly levered institution that is run prone with a lot of academics. And usually when I say that, the eyebrows goes up. They're like, oh. So then the response usually comes back, well, it's going to be completely permissioned in a setting where access is highly restricted. I'm like, oh, okay, so you're just going to put on a terrible database that has a lot of cryptography that does nothing.
Right. Yeah, it's sort of, as you say, the worst of both worlds. It kind of is an incoherent concept of sorts.
Yeah, there's a reason why it's never worked, despite a decade plus of people trying to build permission networks and plowing billions of dollars into it.
What are other things that you feel like either the traditional establishment or academia or even the crypto people just don't get, even though it's so obviously true to you?
One is that the limitations of how our infrastructure works today are often there as a choice. So the stock market does not close at 4 p.m. because the databases of the NASDAQ and the New York Stock Exchange get tired or need to be re-lubricated or something. They have probably some of the world's best, most advanced databases, and they have every ability to run them till 5 p.m. It's same thing for FedWire, same thing for almost anything else in the economy at this point in time. The internet runs 24/7. So if you have financial infrastructure that doesn't, it's usually for one or two reasons. One, the people involved haven't bothered to just invest the capital they need to upgrade. I think that's rare, actually. I think the much bigger issue is that delays and net settlement and T+1.
Somebody's making money.
Somebody's making money. You know, the simplest example of that is ACH. Every week in America, hundreds of millions of people get a paycheck issued by their company, or they get like Social Security benefits issued by the government. They don't get the money until a couple of days later. During that time, somebody else earns the interest on it. It's not the company, and it's not the employee. The money leaves the company on Wednesday, and it doesn't hit your bank account till Friday. So the banking system is making money from it. And it's fascinating to me how, in a way, we are all the frogs who have been slowly boiled over time. Because I've raised this issue for with a lot of people, and they're like, yeah, but what is the interest on if your paycheck is after taxes $1,000 and the APY you could get on it right now is 2%, and you're talking about a 2-day delay, right? And there's 365 days in a year. Like, it's dollars, pennies, nobody cares. I'm like, well, first of all, in aggregate, that adds up to a lot of money. So I think the U.S. Treasury might care that there's a way to save the American taxpayer billions of dollars in float every year from the Social Security disbursements. But more importantly, like, the ignorance of saying that it doesn't matter to someone if they get their paycheck on Wednesday than on Friday, that's one of those things where I'm like, yeah, you got to go talk to some more normal working class. There's a lot of people for whom it makes a huge difference, and maybe they would actually have less credit card debt if they got their paycheck 2 weeks sooner every month or every 2 weeks, and then they're not paying 30% APY to the banks that, you know, really care about credit creation. And there's probably versions of this dynamic that even I don't understand, right? Like the issue of delayed net settlement in capital markets. So if you buy stock today, technically you don't own it till tomorrow. Unless tomorrow's a weekend, but then you don't own it till Monday. Unless actually this Monday I think is a bank holiday, maybe President's Day. So then you might not own it for like 5 days. Again, when I talk to people, I say, yeah, but what's the issue? Like, you have a brokerage account, you can buy and sell all day. Robinhood is free, but that's a forced credit arrangement. If you think about it, there have to be some downstream consequences in terms of cost or features or user lock-in. We know there are black swan events. We would need an hour, but the way all of the retail brokerages rugged the meme stock traders during the meme stock fiasco happened because of delayed settlement in capital markets. But they're probably just like, it's weird, right? I own a stock, I sell it in my Robinhood account. I don't actually get the money for it till tomorrow. And if I want to buy another stock right away, which people often will sell a stock so they can buy another stock right away, then I effectively need a loan from my broker. And maybe they're not actually charging me interest on that, but there have to be downstream consequences to this. But we all have such bias to the way the world has been that it's probably hard to see what they are.
It's kind of in nobody's interest to really look too carefully into this, right? It's
a good point. There's like almost a financial tragedy of the commons here for a lot of these issues, right? Same as with like high frequency trading, right? It's like you have these trading firms that make billions of dollars a year, not really taking any risk. But then, like, no one's incentive. Oh, and then, by the way, the exchanges that are now going on chain, Distributed nodes all across the world, sure, but they make their fastest growing source of revenues from many exchanges is a combination of fees on data and co-location. Well, if you have a fully transparent global blockchain that has 1,000 nodes, you're not going to make money from either one of those things. But the tragedy of the commons is that with high frequency trading, it's not even a crypto thing. You have like every single participant in the equity market losing pips, maybe not even bips, for every share that they buy and sell. So no one's like, I'm buying $1 million worth of stock. So what if a HFT firm makes $10 off of me? But then in aggregate, they make a lot of money, and it sort of like disrupts how the financial system works.
Yeah, it's so fascinating. It seems like so many of these financial institutions are kind of like these psychological games almost, right? It's just the acquisition of, as you put it, like non-consensual credit agreements, getting non-consensual credit in all these weird ways. Like deposits are a form of somewhat non-consensual credit, or at least people don't realize it's credit. The settlement delays are also another form of this credit. Buffett got rich off of insurance float, and Jamie Dimon is rich off of this micro float. It's fascinating.
Yeah. One of the things I'm super excited about as the world moves on chain is that for the first time, we might have infrastructure that allows anything.
Yeah.
And we take for granted how much of the design of our markets today are just because of the infrastructure settlements, right? Like there's a fascinating question. I actually co-authored a paper on this with someone who used to be a senior executive at the European Central Bank. And we asked this question of like, U.S. Treasuries, like the long bond pays interest twice a year. That's just the downstream consequence of the fact that like this literally used to be a coupon bond where it came on a piece of paper and you had coupons that you would clip off once every 6 months and walk over to the Treasury and get your interest. Now, particularly when we go with stablecoins, you could stream money effectively free. This raises this question: what is the optimal frequency of remuneration for any kind of credit product? Right? Another interesting idea: stablecoins. I actually think an unexplored territory is what we call term deposits with stablecoins. So if you're a bank, you have demand deposits, which are like checking savings account. That's the money the depositor could demand at any moment in time. But you have things like certificates of deposit, which are term deposits. That's you saying, I'll lock up my money for 3 months or 11 months. And that's a great innovation, because if the bank knows some of its deposits can be called for till tomorrow, they can invest the money differently,
right,
and term out their duration. Stablecoins can do that. I think they should do it. I think it's going to be awesome in the future. Say we go to the stablecoin issuer and say, you know what, give me this many units that's like instantly redeemable, but for 20% of my money, lock it up for 3 months and pay me more interest on it. Because then that allows the stablecoin issuer to be like, oh, okay, well, 10% of the tokens outstanding are locked up for the next month or 6 months. And I can go buy longer dated treasuries. I don't have to have T-bills or reverse repo. So I am very excited for a future where, with tokens on chain, decentralized global settlement systems, and smart contracts, the whiteboard of how you design financial products becomes infinite. Like the only limit will be people's imagination and what's useful. Right? And crypto's teased us with this. Like I think AMMs and DEXs have teased us with this. We've seen the success of perps, right? Like, oh yeah, that's actually in some cases a much better way to build a derivative market than how traditional futures, regulated futures work. But like, there's so much more. And the question that I don't have an answer to is, once you give users and financial engineers this infinite whiteboard, what makes sense? It's possible some of the things that they decide are just like how the world works today.
Right.
That there are probably financial instruments that are that way because their design is optimal, not because of the limits of the infrastructure. But I think it's also possible that there are some crazy designs. Even I feel like we think of equity, we think of debt. Today we already have some hybrids of the two, like a convertible preferred or something like that. But there's like an infinite variety of esoteric financial instruments, like part equity, part debt, but it's also a currency that used to make payments. I don't know. So I am very excited, and this is always the pitch in my classroom to my students. Like, this could be you. It's not me. I'm too old and not smart enough to go and design the next iteration of like the great security or payment instrument or whatever. But for them, I think we're entering a period of unprecedented innovation in capital markets and payments, and it'll be very exciting to be a part of it.
I think that's a great place to close. Omid, where can people follow you and read more of your thinking?
I have you can Google me, Omid Malekan. I have a Substack, Twitter, @Malekan, OMS, OMS.
And we'll leave why Ben Bernanke was mad at Omid as a kind of a Easter egg.
I would say he was amused and irritated more so than he was mad. But
okay.
Yes, people can go figure it out on their own.
Okay. Well, thank you so much, Omid.
Thanks for having me.